I think that sorry internet that I had in Denver was behaving better than this. Whatever, we'll get it. All right, so a little bit of a mixed bag today. Hong Kong is basically flat and small caps are up the most. So if we're thinking about it from a little bit of a capital rotation point of view, what we've been seeing earlier in the week, was more of a broad-based rally in basically everything that we looked at, with tech dominating. And this morning, it's small caps. We knew towards the end of this week we were going to get more data out of Europe. That's really oh yeah, that's nice. I think that's really a large part of what we're seeing this morning with the hurry up and wait as we get into the end of the week. Next week is a really big deal. We've got FOMC, QRA. We're going to get more job numbers. I don't really see how the market is going to sit in this narrow little range waiting until next week. But that is the biggest thing on everybody's plate right now. Still got to get through the end of the week. Sure, PCE is no joke, but next week's the real deal. We opened underneath the pivot point, which puts us in a bearish posture right away. The thing is, that's just a generic starting point. For an example, back here, we opened underneath the daily pivot point, and around midday, we ripped through that, and we had this rally that lasted through the overnight and into the next day. So the fact that we're opening underneath it puts us in a bearish light, but it's not like we just want to run in and, take a short just because. We also have an MDP, so a missed daily pivot. We did not get one yesterday. We ended up hitting it into the afternoon right before the close. So we almost had an MDP and then we gave it away. But because of that exaggerated move to the upside into the call wall, no less, it did bring the pivot point up today. The math has been bringing the pivot up every day, and now we've ducked underneath that. The volumes are okay. They're a little light, but not enough to be concerning. And even with this low volume, they're not hedging. So, if we get low volume and they're hedging, it shows they're a little worried about the econ that we have on the table for the day. They're concerned, they're sitting out, they're not participating, and they're hedging. Otherwise, they're just sitting out waiting, and that's what we see here. There's not a large amount of participation that we would normally see, but it's not low enough yet to be a major concern. You got to admit that this is a lot of stuff on the table today, including the auctions. Look at when the market changed direction yesterday. It was right on the clock. Afternoon, 1 o'clock auctions. And even earlier in the day, if you look at all the economic events we had on the table yesterday. Today, 8:15, 8:30, 10 o'clock, 10:30, 11, 11:30, 1 o'clock. It's a full house all day today. Any one of these data points could turn things around. So I'm constantly telling people, watch the clock, especially if you're day trading. There's nothing better that you can do. There's no better indicator that you could use in your trading than watch the clock. because this sell-off began at 1 o'clock when data came out. That was 10 o'clock data that popped up off of the lows. Right, so can't stress it enough. It's the cheapest because everybody's got a clock, right? You don't even have to buy one. It's on your computer. The cheapest indicator you could get. So on the week, we're still keeping our breakout. We are starting to give back a little bit. One thing that I like to do when we have a week like this that's beginning to fade a little bit is mark that halfway point. Are we above or below? And as you can see, we're below. We kind of want to keep that, right? What I say, in Pirates of the Caribbean, don't give anything back. Well, there you go, right? We don't want to give any of this back. So you can measure the whole week, just like I did. You can also just go in and measure yesterday's range. We're in the lower half of yesterday's range, and we're on the week. We're in the lower half of that weekly candle of our current week. So we got a little bit of guidance now and a little structure. To close the week out, we want to be above 4902.88. For today, if we're going to get a rally, one of the first things that we got to focus on is getting through the halfway point, a COG line, no less, 4911 COG, COG, center of gravity. Got to get past that 4911. All 11s, 32s, and 91 are COG lines. Now, the amount of time and effort to validate a COG line it's weeks and weeks of work. And I guarantee you I didn't do it. I get tired of doing it when the answers kept turning out to be the same over and over and over. So I quit validating these levels long ago. Right now, I just assume that they're COG lines, even though I haven't validated them. And my assumptions continue to prove me correct because they continue to be critical levels, key levels where price responds. So something to think about. I've had people ask, what did you do to validate them? It takes weeks of work, and it would take an hour and a half to 2 hours just to explain what it is that I have to do to validate the levels. And after a while, you just get tired of validating when you get the same answers, right? So no, they're not technically valid. But until it proves me wrong, I'm going to assume that that's a COG line. Guilty until proven otherwise. Because of the internet issues this morning, I didn't get the spot gamma levels. So I can grab them on TradingView if TradingView will ever load. So far, it's still not loading. I say that, but I forgot about this new one. So I posted this in the chat. That you can import these levels onto your Thinkorswim. I don't have them for the ES, but we can use them on SPY. And structurally, what we see in price will be the same for the, like call wall, put wall, that kind of stuff. That's not encouraging. 10-day, 30-minute volume profile. It's about an 80-point range right now. And like we talked about yesterday, if we continue to hold in this zone, it's very likely we're going to bring that point of control up to us. But we haven't been down there to get it, right? We talked about that yesterday, but we still need to come down here and get there. So as long as we don't do that, we keep distributing this volume as we keep moving around, then we're not going to get a point of control. And we need this to fall away before we lose the point of control down here. So even if we don't come back to this location, if we instead just continue to move about, as the days go by, more new candles on the right here is going to remove candles from the left here. And as that happens, the point of control is going to move up to this location anyways, whether we like it or not. The difference, though, if that happens, is that we'll end up with more of a classic D shape in the profile because all of this stuff will be gone. That won't be there anymore. And we'll just have this. And it'll be a very tight profile. From 48.50 to 49.30, that'll be the 80-point profile. But we still do have all of this. So 47.5, 48.5, there's 100. And then another 75 or so. So very wide profile for 10 days. Even though we don't have the point of control up here yet, keep an eye on that cog line 48.91, 48.90, it's close enough. That is going to be the new point of control. It's very likely that there's unfinished business there. If price does get back into this level, we want to see if it's going to consolidate like it did last time and stay in this base, build a zone here, or if it's going to manage to get through it. If we break through the bottom of that zone, we're very likely going to move back towards the old point of control really fast, just like we did back here. When we moved through there last time, we didn't leave much of a footprint behind. We didn't leave much structure behind either. This would be like a liquidity gap. And we're looking to close that liquidity gap if we break this level. All right. What's that old joke about the airplane? Where does a plane with one engine go? Or how far can it go? Yeah, that's the joke. How far can a plane with one engine go? All the way to the crash site. Yeah, poor joke. We do have a new VPOC, so now we're pinched between the two. A move to the upside or a move to the downside is going to result in hitting one of our VPOC levels. Just keep in mind what these represent, right? They are the point of control for that day. It's a lot of unfinished business. It's where the most trades happened. There's no disputing this, right? It's not like I'm offering you my opinion. That is where the greatest amount of volume happened. We know this. So we have an expectation that when we get back to that level, there's some unfinished business. To kind of lay that out, how would you feel if you had got long here and 2 days later, price is back to your long? Eh? Because that's what we're going to be dealing with if we get back to that. Or how would you feel if you had gone long here at 49.16 and price gets back to your position? So we can look at these two levels and we can argue about their merits or how they might or might not affect price, but that's all our opinion. What we know for a fact is that a lot of trades happened there. It was the most traded spot in the entire trading day. It's where all the largest amount of volume was at. And that if we get back to that location, we can then assume that there's going to yet again be a reaction at that spot. Will it be support, resistance, first touch rejection? Will we even be able to make it through those levels? Those are questions we can plan ahead and have a strategy for. We are still within the week's expected move. Notice what we did yesterday. We peeked our heads outside of the weekly expected move and we came back in again. Remember that we're going to close inside of these boxes 80% of the time on the S&P at the end of the week. So during the week, we can get out of the box and run around, but more often than not, we're going to come back inside before the week ends. 8 out of 10 weeks on the S&P closes inside this box. 70%, 7 out of 10 weeks on any other product. So if you're looking at Apple, Google, Microsoft, whatever, the less option values they have. So if you're looking at something like Travelers that only has monthly options, doesn't even have weeklies, then its range is going to be less accurate than something that has weekly options. And something that has 5 expirations a week is going to be even more accurate than things with weekly options. So the Qs, all the S&P stuff, they're more accurate. But the S&P is the most accurate. For years, the S&P was the experimental product of choice. While everything else had monthly expirations, SPY had weeklies. When everybody else got weeklies, SPY had 3, Monday, Wednesday, and Friday. Once they started giving that to other places, SPY got 5 days a week. It's always been the first, and it's always been the experiment, right? So the S&P has more liquidity, and it has a more accurate expected move than anything else. The SPY and the SPX are way more accurate than the ES when it comes to the weekly levels. Something to consider, right? But I do love it when it does what it's supposed to do. Any rally to the upside at this point, 49.27 has now been broken. I don't believe it has the respect that it had. And yesterday's high, to me, is more important now than that weekly level. And yesterday's high, by the way, was a cog line, 49.32. We're on the decline away from the 10-day. We were above it a considerable amount yesterday, but we gave a lot of it back. We're still more than 0.75% away from the 10-day, but as you can see, we've been higher than that before, right? So are we overbought, overextended, do a pullback just because of how far we've run? Nope. So it doesn't owe us anything. We're still 3.25% away from the 10-week. Now that's not extreme, but it's pretty far away. It's not often that we get this far away. That doesn't mean that we're going to reverse. All we have to do is hold the line here and the 10 will move to us, right? That's just the way it goes. The 10-week will move to us even if we never move towards it. So the question is, can we continue to expand even though we are already this far away from the 10-week? Yeah, we can, but it's more of a challenge at this point. So it won't necessarily make us fall, but it's going to make it harder to go even higher from here. We need a little bit of a reset that we either run back down and tag that 10 or that we stay put long enough for the 10 to come up. They call that correcting through time. And it's a real thing. If you were to Google correcting in time and with Google, you probably have to give it a nudge and say stock market analysis or technical analysis, correction in time rather than correction in price. And you'll learn about this concept. So that's kind of what we're doing here, just holding the line on that weekly. There's been some very weird moves in the last few days that should have greatly affected the market and really didn't. Starting on Tuesday with that monster face ripping move in the dollar index and how the S&P and the NASDAQ really didn't acknowledge that that was happening at all. Then after Tuesday's close, when it reversed the whole thing plus some with this overextended move to the downside, which again, the market really didn't acknowledge. And now we're right back up into that same area. So for the dollar, it's been like a roller coaster, but really hasn't gone anywhere. Same thing with US dollar Japan. We were up, we were down, laugh and cry, and now we're right back where we started. But these are exaggerated moves that was not really felt in the market. And that's something to be concerned about. I was talking with a trader yesterday and they said, well, I was, I trade watching these tools, and they said that these tools weren't helping. I 100% agree. They're not helping. They're not giving you any signals, and price isn't responding to them. One of the things we have to do is recognize when our tools are ineffective, right? And that way we at least know when to ignore them. The bonds are up more this morning than the NASDAQ and the S&P, but that's not saying much. They're barely up. They're just up a little. So normally I'd say keep your eye on these. We want to have a better understanding of what's going on with the dollar and the 10-year and US dollar Japan. But this week that just doesn't seem to apply. Well, that would explain why we weren't getting any volume. So if we swap over to SPY, because I don't have options levels for the futures from this company, we can see the GEX flip is below the previous week's high, 482.72. So we'd have to get below that. And that is a gap still that hasn't been filled. I share the levels for that, right? Every morning, you just got to copy the code and put it in. Yesterday, NVIDIA had almost reached its 7-day move by the end of the day, by the end of that run. It's still going to open today closer to the higher end of this 1 standard deviation move. Think of these two levels as like my ADR levels. We are opening above the daily pivot point. But, we talk about the narrow channel sometimes. Look how narrow that channel is this morning. Man, it'll get that way on the ES once in a while too, but that's a really narrow channel. Airlines, semiconductors, Bitcoin, China, gold, and all the way at the back of the bus, tech. That's it. Really, I know I kind of said like that's it, but that's a lot. We've got a lot to work with. On the downside, healthcare and consumer discretionary and the FANGs, which, Tesla kind of got gut punched yesterday. So went into the close at 207. You're looking at 187. I'm just rounding for some easy numbers. That's a 20-point move. It was down 6% after hours when I measured it last. It's now down 9%. 9%'s not bad for Tesla. This is really noisy, though. We got to get rid of some of this stuff. Oh, yeah, it's a little better. We've already passed how far it should have took 7 days to get there. That's the 7-day expected move. It's like the whole week. The difference is this is the week move that it should take. Like if you marked it today, a week from now, we should have moved that far. We moved that far in an entire day. And every day that level resets. So it's not like my weekly expected move levels. But that just shows how far Tesla's moved in a single day. Now, Thinkorswim doesn't show pre-market on the daily chart. That's usually why I would use TrendSpider right now. But with the internet issues that I was talking about earlier, I'm pretty sure that if I try to go look at TrendSpider, it's not going to work. We could try. Maybe. Hey, maybe. So now we can see this move in Tesla on the daily chart. Whoa. Should have. Oh, there it is. So this is a really big double bottom at this point. We don't know that it's going to turn into a breakout, or in this case, a breakdown and a continuation to the downside. We don't know that yet because we haven't expanded far enough yet for that to qualify, to count. Right now, what we need to be concerned about is that a double bottom is a bear trap, and we're supposed to go lower than the previous low deliberately on purpose, that we're supposed to go lower to trap the bears and convince them that we're really breaking down so that they get in and then we rug pull and rip their heads off. So 186 is that line in the sand. That's my warning center, 1.11. It's halfway, not perfectly half, but it's halfway to the 1236, which would be the start of the breakdown level for a trend and a continuation to the downside. So what we want to be watching in Tesla today is to see if it's going to tangle around that 186. And look, we can overshoot it. We can, wick down through it because it's a daily chart. If we close on the day below that level, then we'll have to reevaluate. But if we close, if we get to that level, overshoot it, come back up through it and close above it, well, then that's a completely different story. That's what we're looking for. If we were looking for it to continue to the downside, we would have expected it to come back and bounce off of that level and give us like an inverted cup and handle, and then a continuation to the downside. But it didn't bounce on that level, and it didn't pull back up first. And so we didn't get that inverse cup and handle. Instead, we broke through it, which at this point sets us up for that double bottom feature. So if we break through this 111 and we continue moving towards the 1236, then that'll be our target. At that point, we'll expect to touch the level, maybe overshoot it, maybe not, doesn't really matter too much on that point. But then we expect opposite candle color, and we'll be able to move our fibs down to that level next. But that's days from now. That really won't help us. Today, it's just going to be, how do we respond around that 186? And if we do break through the 186, then we're going to 177. All right, semiconductors are up again this morning, but it's not really encouraging. We're still inside yesterday's range. Guess I should have refreshed before I came to this level. That's okay. So that's the big deal. We got to get outside of yesterday's range. We're up a little bit this morning. One of the concerns is that we rally up, we hit our head on yesterday's high, and then we break this moving average here, is 3-period moving average, and we start a trip to the downside focused on that 10 MA. But until we break that, then we're still in the surge play, right? The surge was when price crossed both of those moving averages, and then the 3 crossed the 10. And we've held above that 3 ever since. Excuse me, that's not the 10, that's just VWAP. So we're just looking at that one level, which is still a surge once we get price above that level. So with semis today, it needs to get above this high. And if we can manage to do that, then we can just measure yesterday's candle and lay out our levels. That's a pretty good gap up yesterday, and we've already got another gap up again this morning. If we're going to turn bearish, I think that'd be a really nice setup. We gap up, come up and hit our head, start that move to the downside. I would want to break yesterday's close first. That could trigger the entry short. Then getting below yesterday's low, we would target this gap close. I wouldn't get all bared up, like a long-term short. We're just talking about, trading a little bit of this to the downside. And it's easy to think about shorting something that is up this much, but I'll put in a little bit of caution that we don't know the run is done yet. It looked like it was done back here. We crossed through the 10 and the 20, and it sure looked really nasty. And then we got that. and we thought it was done. We got some digestion, and then, all of this weakness, it looked really nasty, and we thought it was done. And now we got this. So I'm going to just add that caution, right? A short-term trade for a short. If we're looking for a short, it'd be a day, maybe two, in and out, quick. So we can see the airlines are up this morning. These are the ones that I tend to focus on the most. You do have your ETF jets, but you can also look at the individual airlines and try to pick out one that, suits you a little bit better. American Airlines had that really nice pop up. Airlines are cheap companies, they have reasonably decent options. They make a fun day trade, a profitable day trade too, of course. So, they're always something to consider on days where we're getting a little bit of attention out of those. Let's see how it's. Oh, 05. I didn't get it right. Estimated was 059 and actual was 03. So they must have said something good. I would look for this to kind of get tangled up around that $15 mark. And of course, we still need to know what was said in the earnings. But that's the halfway point. We're getting close to it anyways. If we can get above it, we can target $17 in a swing trade. And if we look at how things have been going since this last earnings, they worked their way up towards that halfback. So, we got kind of close and we've been digesting, waiting for the next earnings. This new earnings could propel us up to that next level, right? These earnings got us all the way up to 19. And of course, those earnings brought us all the way back down. So turning things around a little bit for a swing trade, getting into 17 would be a really good start. Back to 19, even better. But for longer term trades, like a buy and hold or adding this to the portfolio, not me. Airlines are poorly run companies and I don't want them in my portfolio long term. But for trading's a whole different animal, right? So 1470, we're right at that now in the pre-market anyways. If we can get through that zone, then we could look for an expansion. And just to kind of clean it up a little bit. 1562, if we can get through that 15. So you got 1467. We got to get through that in the pre-market. Shoot through that to $15 and then 1562. At least we got level by level at that point, right? Kind of work our way up. Otherwise, if we reject, which, we don't know how the earnings went yet, what everything they had to say. If we reject, then we'll focus on this halfback, 1375. And below that, we'll focus on $13. Yeah, the cruise lines, airlines, they are poorly run companies. They're like the laughing stock of trading, they're the butt of all the poorly run company jokes. So I mean, if someone gave me stock, I'd probably hang on to it. You know, like when you get a free share from Robinhood or something. I probably wouldn't sell it, but yeah, you don't want to hold those. If you do want to trade in these, use something like the ETF, or maybe I'm sure there is some kind of mutual fund that deals with entertainment, right? And try to go that route. That way, at least it's a blend that has cruise lines, casinos with resorts, and maybe it just kind of all ties in there together. But hotels aren't really all that great either. I mean, Marriott, you kind of go down the list. They're not that hot either. What is that big building in California? What was it, Los Angeles or San Francisco, where it's just a massive hotel and they were in debt to their eyeballs, and they just told the bank, forget it, man. We're tired of even just paying the premium on this thing. You can have it. Of course, the bank don't want it. It's this massive hotel. I want to say it was the Hilton, but I don't know for sure. I don't remember anymore. I forgot. So at this point, we want to continue to look for those rally to broaden out into other sectors, preferably into our risk on sectors, something like tech, cloud computing, communications. We want to see more out of semiconductors, but it can't just be semiconductors, right? That's not going to be enough. I would continue to keep my eye on bonds, the dollar, the 10-year, but I have to say this week, they've made some very wild moves and the market just didn't care. So watch the clock. We got a lot of things coming in today. Look for the rally to spread out. And that means too that some of the tools that you're going to use, like tick and maybe weighted AD, they're very likely not going to behave very well if the rally isn't in key places that we would normally be looking, like tech and communications, semiconductors, things like that. So I'd be a little cautious with the tick chart, the weighted AD, even just a regular advancing and declining. Keep your eye on those. Look for subtle shifts and wait for news, right? Wait on the clock. We're tightly wound. Remember that we've learned that when market builds energy when it's sideways, it's literally just winding up more and more and more energy. So what it does with that energy, when a market makes a move, that move can be made to build energy, or that move can be made to burn the energy that it has been building. You can monitor that using the RSI Liggear. And that way in the move, you got a pretty good idea as you get into resistance. Have you burnt all your energy out? Did you get to that resistance as you was collecting energy? We're wound up. We're right at the VWAP. We're basically equal distant at this point. Everything it gave us to the upside, it has already given us to the downside. We are like a penny balanced on the edge right now. All we got to do is leave this zone, and that'll be our trigger, higher or lower. It doesn't get much better than that. Everybody be careful, be safe. I will see you all tomorrow, hopefully with better internet than this.